welcome to this lecture. My name is Sherwin, by the way, and this video is ought to provide the concepts of notes receivable. So sit back and enjoy this video. First, what do we mean when we say notes receivable? Notes receivable is a claim supported by a formal promise to pay a certain sum of money at a specific future date, usually in the form of a promissory note. The negotiable promissory note means that there is an unconditional promise in writing made by one person to another. A promissory note is a written contract in which one person, known as the maker, promises to pay another person, known as the payee, who holds the note receivable and who expects receive a definite sum of money. For example, Company A sells machinery to Company B for $300,000 with payment due within 30 days. After 45 days of non-payment by Company B, both parties agree that Company B will issue a note payable for the principal amount of $300,000 at an interest rate of 10%. In this example, Company A records a notes receivable entry on its balance sheet, while Company B records a notes payable entry on its balance sheet. The notes receivable is used to facilitate sales with longer, interest-bearing payment terms. For the entity doing the lending, also known as a payee or creditor, notes receivable can improve cash flow. Key components of notes receivable. It is important to formalize all the key components of a note receivable so the terms are clear for the maker. A note receivable may also be used as evidence if the payee needs to pursue legal action. The key component of notes receivable includes: first, the payee or the creditor entity that owed the principal and interest. The payee is the one who holds the notes receivable and expects to receive payment from the maker when the note is due. The payee is the one who classifies the note as a note receivable. Second, the maker or the entity required to pay back the note, also known as the borrower or debtor. Third, the principal or the original amount of the note. In a simple case, the principal is the amount of cash that the payee gives to the maker, who pays back the amount by the end of the term, either in installments or a lump sum. Fourth, the term or time frame, which signifies the amount of time the maker has to pay back the note. Fifth, the interest, the money that maker pays the payee in addition to the principal. It is the cost of borrowing the money. And lastly, the interest rate, the note's stated rate of interest expressed on an annual basis. The interest rate is applied to the outstanding principal to determine the amount of interest owed by the maker. However, how do notes receivable differs from accounts receivable? It is said that the notes receivable is a legal contract with established payment terms since it involves the principal, interest, and time frame. It is receivable beyond 1 year and outside of a company's operating cycle, while the accounts receivable is an informal agreement between customer and company. This transaction does not include interest and commonly collectible in less than 1 year. Have you ever wondered why some entities accept notes receivable in the conduct of their operation? Businesses may be open to notes receivable for customers because if they attach interest terms to the promissory note, the organization actually receives more money than it may have otherwise. And also, notes receivable is a way for the customers to acknowledge their debts and enter into an agreement with the entity which is more likely to secure the funds owed to the business. For example, Maya was an owner of furniture shop. She sold a furniture worth $5,000 on account to a common customer. Later on, the customer expressed that she has some difficulty in repaying the debt, in which the customer issued a notes receivable and consequently accepted by the furniture shop. In this case, it is beneficial to both the business entity and the customer because the entity receives income for interest accrued, which equates to more money for the shop, and the customer has more time to pay the debt than they originally did. And now, let's discuss the initial and subsequent measurement of notes receivable. First, short-term notes receivables. The short-term notes receivable is initially measured at fair value plus transaction costs. Fair value may be equal to face amount or present value when the transaction contains a significant financing component, or transaction price with allowed practical expedient for trade receivables and subsequently measured depending on its initial measurement. Therefore, if the initial measurement is face amount, the subsequent measurement is recoverable historical cost. If the initial measurement is present value, the subsequent measurement is amortized cost. If the initial measurement is transaction price, the measurement is subsequently updated using the principles of PFRS 15. Second, long-term notes receivables with reasonable interest rate. The long-term notes receivables with reasonable interest rate is initially measured at fair value plus transaction costs. The fair value is equal to face amount and subsequently measured at recoverable historical cost. Recoverable historical cost, or net realizable value, represents the amount of cash expected to be recovered from the principal amount of the receivable. Third, long-term non-interest-bearing notes receivables. The long-term non-interest-bearing notes receivables is initially measured at fair value plus transaction costs. The fair value is equal to the present value of future cash flow from the receivable and subsequently measured at amortized cost. Fourth, long-term notes receivables bearing with unreasonable interest rate. Long-term notes receivables bearing with unreasonable interest rate is initially measured at fair value plus transaction costs. The fair value is equal to the present value of future cash flows from the receivable and subsequently measured at amortized cost. The notes receivable can be classified as short-term notes or long-term notes receivable. The determining factor of short and long-term notes receivable is time. In the statement of financial position, notes that are due within 12 months or less are called short-term notes receivable, which are considered as current assets. However, if the note is due in more than a year, then it is classified as long-term notes receivable and presented as non-current assets. For example, Anna was the accountant of ABC Company. She later found out that the entity holds notes receivables from two major customers. The first notes receivable will due within this year, and the other one will due the next year. In this case, the notes receivable that will due within the year will be considered as current assets, while the other one that will due next year is considered as non-current assets. Comparison of interest-bearing notes and non-interest-bearing notes receivable. The notes receivable can also be classified as interest-bearing notes or non-interest-bearing notes receivable. A non-interest-bearing note is a note with no stated interest rate on its face. Contrary to the name, non-interest-bearing notes do actually pay interest. The interest is implied in the face value of the note. This kind of notes receivable is actually measured in present value, which is the discounted value of future cash flows, while an interest-bearing note receivable requires the principal plus interest to be collected on the maturity date. This note is measured at face value, which is actually the present value upon issuance. For example, Tom was the newly hired accountant of ABC Company, and he later on found out that the company held two notes receivable. The first note was a non-interest-bearing notes receivable, and the other on he was an interest-bearing notes receivable. And in this time, he cannot mess up, and he must impress his new boss, Jerry. So he immediately recalls his lesson way back in college and remembered that if it was a non-interest-bearing notes receivable, he must initially record it at present value and subsequently record at amortized cost by getting the face value and then deducting the unamortized unearned interest income. While the interest-bearing notes receivable must be initially recorded in face value. Therefore, the entity expects to collect the principal plus interest. So he instantly grabs the record book and recorded the 2 notes receivable, appropriately which made up his day. So that wraps it up. I hope you enjoyed the video. And if you learned something new for today, then give the video a like and share it with your friends. Thank you for watching.